There's one line item on your tax return that's costing you thousands. And the fact is, most people are just unaware of what it is. It's taxable income. This tells us how much of the income you have is subject to the various tax rates. And please don't misunderstand me here. There's other line items that are just as impactful. But if I was to look at one, taxable income tells me where you're sitting in your current tax bracket and all the other sources of income that you have that are causing you to be there. If all you have is money coming from a job, well, we don't have a lot of options. But if you have investments and maybe real estate, a side hustle, and you've saved assets, then now we have a little bit more flexibility with the timing and recognition of income. And the more we can adjust your income for tax purposes, the better off we can be, the more in control you can be. Let's face it, throughout the majority of your life, you've probably felt that you're merciless. Excuse me, I should say that you're without control to the merciless tax law, that you just had to kind of go to and fro with wherever it pushed you. But that's not the case when you have assets. When you have savings built up and you're entering retirement, maybe you've got choices. You can control, do I want to accelerate income? Maybe that would look like a Roth conversion, where you move money from pre-tax retirement accounts to Roth, and you're actually increasing the amount of taxable income you have in a given year to be more tax efficient over your lifetime. Don't just let the tax code happen to you. Be proactive, and please don't just focus on this current tax year. Focus on the long term, because I don't want you to pay more in taxes, significantly more in taxes in retirement, because you were trying to save a couple bucks today. And that's the case when you save too much money in a 401k or IRA and just defer the recognition of taxable income into the future. I mean, that's really what's going on. When you or your employer puts money into a 401k on a pre-tax basis, you're just kicking that tax liability down the road, and eventually it will come upon you. When you reach a required minimum distribution age, typically in your 70s, now the government starts to force money out of your 401k or IRA, regardless if you need the money or not to live on. If you unwisely ignore the planning opportunity ahead of you, then you will find your hands will be tied behind your back and you'll be forced to pony up and pay the tax on those distributions. Now, for some of you, RMDs won't make a huge difference because you haven't saved that much. But for a good chunk of you who have saved throughout your life, invested wisely, and lived beneath your means, this could be something to be aware of, because required minimum distributions catch a lot of retirees off guard. And as they're spitting money out of your IRA and 401k, guess where it shows up? Taxable income, right alongside the Social Security benefits that you're receiving, which are likely subject to tax as well. This brings me to another point: investment allocation. So, making sure your investments are put in the right place is just as important as making sure that the money's in the right type of account. Account allocation might even be more important than investment allocation in many situations. Because if you have too much money in pre tax assets or too much money in tax free assets, although most people aren't kicking themselves that they have too much money in tax free assets, like a Roth or a health savings account. But if you're overweighted in one area or another, it can prevent you from taking advantage of opportunities when they arise. I spoke with an individual recently. They wanted to take out a few $100,000 from their IRA. They're in their early 60s. They've got a few rental properties in the East Coast, and they want to move to kind of their long-term retirement home. They just don't have the money in the bank or somewhere else to pull it out to put that down payment on the new home. And they're going to turn their current home into a rental property. So it's not like they can sell it and use the proceeds to buy the new place. They came to me saying, we want to take a few dollars out of our IRA. And by the way, they're both still working, and use that as a down payment. And then the following year, we'll take the money out of the Roth to cover the tax. That's unwise. Here's why. They're working, and now all of a sudden we're adding on IRA distributions on top of that, which is increasing their taxable income in the year that they close on the home. And then in the following year, likely when they were retired, or at least one spouse will retire next year. Well, now their ordinary income is going to drop, their wage income is going to drop, and they're going to be taking money out of a tax-free asset to pay the tax liability for the distributions they took out the previous year. Unwise, because what we've just done is created a peak and now a valley the following year from a tax perspective. They have pushed themselves into significantly higher tax brackets by taking money out in this way to cover this expense. Now, I want them to have the dream home. I want them to enjoy retirement, especially in their early 60s. I want them to be successful. And I think most financial advisors want that for their clients, most good ones. But it would have been much wiser if they had done a combination, a blend of distributions from both pre-tax IRAs and Roth IRAs in the year they needed the down payment on that home. And then in the following year, when they take the money out to cover the tax liability, the majority of that would then come from the pre-tax asset. Why would that be the case? And by the way, they had a little bit in a Roth. It was like 50 or 60,000, so not enough to cover the whole down payment. They were going to have to take some from the IRA either way. But the reason it wouldn't have made sense to take the money out of the Roth in the year they were putting money on a down payment and delay taking money out of an IRA, at least a big chunk of it, until the second year, is because we're trying to smooth out their taxable income. We don't want to see them in a really high tax bracket one year and a really low one the following, because they haven't been as efficient. And I don't have to tell you, it's much easier to save money on taxes by just doing a little bit of planning and strategy beforehand than it is to try and squeeze extra returns out of your investments, as good as those mutual funds or exchange trade funds may be for you. Tax planning goes hand in hand with investment planning and retirement planning. Don't ignore one or focus just on the investment returns. I found, especially with men, that they'll spend hours and hours and hours reading articles or watching videos trying to find the best investment or the best investment allocation. What percentage should I have in this versus this? But they do not spend nearly as much time learning some basic key principles around tax planning and saving, especially as they enter retirement. But that's not you. You're here with me, and you know the value of comprehensive financial planning. If you want to learn more, consider checking out a copy of my new book, Finance on the Fly: Simple Strategies to Build Lasting Wealth. It's an insightful, plain English guide that will guide you and your loved ones toward financial peace, confidence, and creating a plan that works for you. If you know someone who needs to hear this, please share this video with them.